The Bank of Canada has increased the key interest rate by 0.5% for the first time in 22 years. And although the news headlines may be seeming like the world is coming to an end, I'm here to tell you that it's not. But there are some things you should know about these changes. Hi, my name is Matt. I work with the Linda Maguire Team. And in this video, we're going to break down the recent interest rate increase from the Bank of Canada, why it happened, what it means to you, and where we go next from here. Now we're going to look at an article from Tiff Macklem and the Bank of Canada, but before we do, let's talk about what happened. So like I said in the intro, the Bank of Canada increased their key overnight interest rate from 0.5% up to 1%. So that 0.5% jump was the biggest we've seen in over 2 decades, but I think it was needed right now. So why did this happen? Why did the bank increase the interest rates? Well, they released a statement here that we're going to look at, and it mentions 3 main points and reasons why they increased the interest rates. So you can see here, it says the first is the Canadian economy is strong. Overall, the economy has fully recovered from the pandemic and is now moving into excess demand. Second, inflation is too high, and this is a really big one. It is higher than we expected, and it's going to be elevated for longer than we previously thought. And third, we need higher interest rates. It's as simple as that. Our policy interest rate is our prime tool to keep the economy in balance and bring inflation back to the target 2%. This morning, we raised our policy rate by 50 basis points to 1%. And we indicated Canadians should expect further increases. So this talks about the 3 points why they increased the interest rates. 1, the economy is doing well. 2, inflation is way too high. And 3, we just need higher interest rates. If you're not aware of what high inflation may look like on a number basis, it actually says here that the CPI inflation in Canada hit a 3-decade high of 5.7% in February. So when we're talking about inflation being too high, their Bank of Canada's target is typically around 2%, and being close to 6% and higher than we've seen in almost 3 decades, I can see why the Bank of Canada increased the interest rate by 50 basis points at one time, and I think it's good that they did that. Another really great point in this article that they make when you talk about why the Bank of Canada increased these rates is there's a statement here. It is important to remember that we have an inflation target and not an interest rate target. This means governing council is not on autopilot to a preset destination for policy interest rate. How high rates go will depend on the economy responds and how the outlook for inflation evolves. So kind of like we talked about, the government is increasing these prime rates to combat inflation, and they're not trying to get to a certain interest rate. They're just trying to bring the inflation back down to the target inflation rate. And I think that's really important to understand as you discuss and look into things like this. So next, let's talk about what this may mean to you. If you have a fixed rate, you will not see the effect of this right away. What I mean by that is if you're locked into a 5-year fixed mortgage and you're only about a year in, your rate is not going to change regardless of what year you are in that mortgage. That being said, if rates continue to rise and they do stay high for some years to come, you may experience what is called rate shock, where you have a low rate, let's say 2%, and in 3-4 years when your mortgage is up, rates may be at 4%, and now your payments change based on that 2% difference in rates. But for the time being, if you have a fixed rate, your payments will not change on your mortgage. If you have a traditional variable non-adjustable mortgage, which is what most of the variables mortgages are from the big banks, you will also not see any changes to your monthly payments. However, more of your monthly payment will go towards interest and less will go towards principal. So you will actually be paying off less of your mortgage because of these interest rate increases. On the flip side, if you have a variable adjustable mortgage, you will see changes to your mortgage payments as soon as your next payment is due, because your mortgage payment fluctuates with the interest rates that you have. Now that's how it affects people that have a mortgage, but what if you don't have a mortgage, and what if you're looking to get pre-approved or get into the market right now? We were on a really great call the other day where the speaker said that every time rates go up by 0.25%, buyers' affordability decreases by roughly 4%. So this recent increase of 0.5% would decrease buying power on average by about 8%. So that's a pretty large number, and that decrease in affordability that we're going to see for people trying to get into the market is definitely going to have an impact on prices and demand in the market. And finally, where do we go from here? Where is the Bank of Canada's interest rate expected to go? What about inflation in the economy? The first thing I want to make clear is just because the Bank of Canada's interest rate goes up 0.5% does not mean the bank's fixed rates for mortgages are going to go up 0.5% as well. Most of the major banks have actually included this 0.5% increase into their recent fixed rates that they've released because they knew it was coming. The Bank of Canada has been very transparent with the fact that they intend to continue to increase the prime interest rate to combat the high levels of inflation that we're seeing. And they made a great point in the article here. It says Canadians should expect interest rates to continue to rise towards more normal settings. By more normal, we mean within the range we consider for a neutral rate of interest that neither stimulates nor weighs on the economy. The neutral interest rate isn't something that we can measure directly. We have to estimate it. And our estimate is between 2% and 3%. Today, we raised our policy rate to 1%, still well below neutral. This is also well below the pre-pandemic policy rate of 1.75%. So like they said there, they're going to continue to increase these rates until that is at a more neutral level. A lot of the economists are talking about when these interest rates increases are going to happen, and it's likely that we will see another one within the next couple of months. And as these interest rate increases happen, we will be right here to update you on what is happening. So that's it for this video. We hope you enjoyed. We'd love to hear your feedback, so leave a comment below. Let me know what you think of these recent interest rate increases or what you think of our takes on them. Have a great day, and we'll talk to you soon.